Yes. So should I?
Okay, well, welcome back to the Peterson Institute, to everybody here in the room and to our audience around the world. My name is Jacob Kirkegaard, and it's a pleasure to welcome you all on behalf of also Peterson Institute President Madam Posen to the next installment of Peterson Macro Week. This time we are pleased to welcome the Deputy Governor of the Banque de France, Agnès Bénassy-Quéré, for a conversation about the monetary policy transmission across the euro area. This is obviously in light of, I think it's fair to say, the gathering economic clouds on the euro area, a very timely subject, and we're very pleased to have the Deputy Governor here to address this set of issues. Before she joined as Deputy Governor of the Banque de France, she has a very distinguished career in academia in her native France. She was also the chief economist of the French Treasury. I promise you we won't hold that against you today in light of recent events. She has also been the deputy chair of the Economic Analysis Council, the director of CEPI, as well as being a resident researcher at another think tank, our sister think tank, I think it's fair to say, in Brussels, Bruegel, and the head of the CEPR Research Network for European Economic Architecture. So without further ado, I would like to welcome on the stage, Deputy Governor.
Thank you very much, Jacob. Thank you for the invitation here. It's a great pleasure to be here and to share some thoughts about the transmission of monetary policy across the euro area. Hello to those who are online who I cannot see. So I would like to start with quite aggregate view of the monetary policy transmission and then move to heterogeneity across countries first, and then zoom in on heterogeneities across firms, especially firm size. And the third part will concentrate on micro data from French firms. So let's first have a look at the monetary policy transmission on aggregate for the euro area. Here is the last euro area outlook that was released by the ECB in September 24. And you see on the right-hand side of the table the difference with the June 24 outlook. So for 24, as you know, the current estimation is 0.8% growth for the euro area as a whole. So it's weak but non-negative growth, I would say, and rising to 1.3% in 25 and 1.5% in 26. So a recovery ahead. In terms of inflation, this inflation is well on track with zero revision, as you see on the right-hand side with respect to June, with average inflation in 24 being 2.5% and down to 2.2% in next year and a little less than 2% in 26. And core inflation is lagging behind, which is the case in all countries, and but well on track also going back to 2% in 26. So the next outlook will be published in December. We'll see what may change. Of course, we have soft data running and also hard data on inflation with some surprises on the downside of on activity, and inflation going downwards as anticipated. Now, digging a little bit into the recovery and the details of this macro outlook. So on the left-hand side, you have the contributions of the GDP growth for the different years. And what you see, so I don't know if I can point here. Not sure. So the investment has a negative contribution in 24, becoming slightly positive in 25 and more positive in 26. This is the green, dark green part of the bars. And consumption, which has a positive but weak contribution in 24, becomes more robust in 25 and 26. These are the red bars. So what is the core the reasoning of this outlook? You have it on the right-hand side. We see that private consumption has been a bit weak in recent years, despite a rise in disposable income, in particular in relation with a robust employment outlook. So why is it so? The savings rate, and this is really specific in the euro area, the savings rate has been on the rise since 22. So we expect this savings rate to slightly decline, and because today it's well above the pre-COVID level in several countries. And also in 24 and 25, we expect real wages to go up. So although employment would stabilize, each employment would produce a higher purchasing power for the workers. In terms of private investment, you have it so on the right-hand side, I'm reporting the growth rate that are included in the forecasts. So the bottom table gives the growth rate of private investment, aggregating household and investments. So it is expected a slight recovery in 25 on investment, and even more in 26 with, and we are going to concentrate on this, of course, talk. In terms of inflation, you know this graph, I will not discuss much. What I want to say is that there is a discussion in terms of disinflation, what is the contribution of monetary policy in the disinflation since the peak of October 22, which was at 10.6% year on year. For headline inflation. The beginning of the disinflation, as you see in terms of contributions, is mostly due to energy and food, and this is largely beyond the reach of monetary policy. But then monetary policy becomes extremely important, especially for the blue part, which is services inflation. Services inflation is lagging behind because it's mostly second-round effects through wage increases, and also for industrial goods. So we've done some research at Banque de France to calculate the contribution of monetary policy in the disinflation process. So this is the left-hand side graph. So the black line is headline inflation over time. It's a quarterly data. So you still have the peak in the fall of 22, and then the decline. And the dotted blue line, gives a counterfactual scenario where monetary policy would have been the one that was expected by markets in December 21, so with no reaction to the surge of inflation. So you see that for the beginning of the period, there is not much difference between the dotted line and the plain line, meaning that most of the disinflation comes from elsewhere, energy prices. But then the gap between the two lines widens, and in 24, we estimate 2.9 percentage point contribution of monetary policy to the disinflation. So this is very large. And it goes on in 25, slightly less, at 2.3 percentage points. So I think we should not oppose the story of disinflation driven by energy prices, and disinflation driven by monetary policy. These are complementary, and we all know that monetary policy acts with a delay. So it's not a surprise that the main effect comes in the course of 23 and even more in 24. On top of this, so this counterfactual, and I want to insist on this, this counterfactual analysis, it's based on a VAR model that is estimated with a Bayesian method. And what is important is that we assume that expectations remain anchored in the dotted line, which is far from obvious if monetary policy had not reacted to the surge of inflation. Where would have gone inflationary expectations? And some other studies internally, for instance, show that the need to increase, so as you know, policy rates increased by 450 basis points from July 22 to September 23. And what they estimate is that, so with another methodology, is that without inflation expectations remaining anchored, the increase in the interest rate should have been something gone to 8% instead of 4%. So it's extremely important, this channel of, and this is something that distinguishes the recent inflationary cycle from past cycles, especially the 1970s. Now, let me dig into the differences across countries. So here you have the same so-called Christmas tree of inflation with different countries, the four main euro area countries, and you see a lot of differences. I will not go into the details of the differences. On the left-hand side, you have headline inflation. On the right-hand side, you have core inflation. Be careful, the scale is not the same. But even with core inflation, you have differences with, for instance, the latest data. You see Germany above, say, Italy, and the difference between the two is about 1 percentage point for core inflation, which is sizable. Okay, so the question now is, why do we get these differences across countries? So there are different possible explanations. The first one, the most straightforward, is government intervention. We know that during the energy crisis, the different governments adopted different strategies. For instance, in France, there were these so-called energy shields, caps on energy prices. So the strategy was to smooth out the impact of the energy shock, which means a plateau of inflation. So less increase in inflation when energy prices go up, but less decrease when energy prices go down. Other explanations have to do, so a second explanation has to do with wage setting systems. So there is a paper, ECB working paper, that summarizes the different wage setting systems in the different countries. And on average, wage settings, collective wage setting in the euro area is staggered, but on average, it's about 2 years. So the contracts are about 2 years. So not the contracts, the length of the collective agreements is about 2 years. But there is some heterogeneity. And so the shortest are found in, for instance, in France, it's every year. In Austria and Portugal also. And at the other end of the spectrum, you have Italy and Spain, where it could be 3 to 4 years. In between, you have Germany, Netherlands, and Belgium. It's every 2 years. In the case of Belgium, it's every 2 years for the real wage, but it's due to wage indexation. Within the 2 years, you have changes also of the nominal wages. So this could explain the timing of second round effect. And if you look at the waves of inflation in the different countries, it's really the case that you have the different waves. And what makes us quite confident about the disinflation is that, for instance, when you look at Germany, where you have some dynamic of wages, if you replicate what has happened in those countries that have completed the cycle, like France, Austria, or Portugal, you can be confident because you see that there has been wage catch-up, but no more than wage catch-up. The third you suspect is very familiar probably to most of you, is differences in economic structure. So you have here the share of, on the right-hand side, the share of industry in value added in the different in different euro area countries, and you see, as you know, that in Germany the share is 24%. This is the highest in the euro area. Industry is capital intensive, so it is supposed to be more sensitive to interest rates. Now, in this talk, I want to focus on monetary policy transmission, and mostly on the indirect transmission channel of transmission to non-financial corporations. So I will leave the household aside. I can answer questions about the household, but I will leave them aside, concentrate on non-financial corporations. And you could have differences across countries in terms of how policy rates are transmitted onto lending rates. You could have also, of course, differences in terms of leverage and cash buffers, and also debt structure. So let's start with non-financial companies, or NFCs, leverage. So here you have the consolidated leverage aggregate leverage of NFCs in percent of GDP for different euro area countries. The black line is the euro area, sorry, it's in French, but I think you can understand, with a decline of the gross debt in percent of GDP over the last decade, since the global financial crisis, or a little more than a decade. And it's also the same in Italy. It's rather stable in Germany, and you have the hump shape in Spain, peaking at the global financial crisis. However, it's important also to look at the asset side. So I'm used to say, well, firms have debts, but they also have assets. So let's look at the asset side and calculate the net debt, which is the gross debt minus cash holdings, which can be deposits or can be short-term investments. And here, again, you have a decline of net debt at the euro area levels, the black line, over time. You have the hump shape for Spain, you have the decline for Italy, you have more or less stability for Germany, and you have an increase for France, which is less than in the other case. So the takeaway here is that in France there is more leverage, firms have more leverage, but they also have more cash, and it happened to be that initially, and I will show that, initially the impact through cash was quicker than the impact through debt. So they have larger balance sheets, which is a major difference across euro area countries. So here I show the impact through cash holdings. On the left-hand side, you have the interest rate on deposits in percent for French firms, but it's also the case in around the euro area, with a large divergence, of course, between overnight deposits in blue, which have slightly increased, and time deposits, where you see an increase in the interest rate on time deposits, which is almost as large and as fast as the policy rate. And what we see from the detailed data, financial data, is that firms have quickly switched their cash from sight deposits, overnight deposits, to time deposits. Hence, they have very quickly taken the opportunity of having a better return on their cash holdings. And their cash holding, and this is what we see on the right-hand side, there is an upward trend in cash holdings in terms of days of sales. It used to be in 2012, take SMEs, small and medium enterprises, about 30 days of sales, and it is now more like 50 days of sales. So they have cash, and during the COVID crisis, the government extended, so this is for France, but you see a kind of this trend everywhere. During the COVID crisis, firms were given extended some state-guaranteed loans, and which were used, the take-up was very high. It was used by SMEs as a cash buffer, kind of insurance, but kept in cash. And this, they are now reimbursing, so we are back to the trend, which is quite high. And we see that the green line, which is for micro enterprises, less than 10 employees, you have even higher cash. So it's not like these small firms have been immediately badly hit by this increase in interest rate. On the contrary, they got higher return on their cash deposits. Second item, so now I move to the liability side, which probably you all have in mind, and starting with the maturity of the debt. And here we also have a lot of heterogeneity. On the left-hand side, you have the debt structure of non-financial corporations for the euro area. There is a mistake here, it's for bank and non-bank debt. And you see three countries on the left-hand side, the extreme left part of the graph, which are Germany, the Netherlands, and France. And in these three countries, leverage at variable rate is about 20% of total debt only. And if you add leverage at fixed rate but short maturity, the total is about 40% of the total debt, compared to up to 90% in Latvia and Estonia. So here you see really a big heterogeneity, which means that initially, so this is very important, when the interest rate goes up, you have two effects. You have the direct effect, which is intertemporal substitution effect, which it depends on the pass-through of the policy rate on the lending rates. And then you have the indirect channel, which is through the balance sheet, and the fact that interest payments go up when the debt is rolled over. On the right-hand side of the graph, you have a little bit of the same information, which is the x-axis, the share of variable rate debt, which is about 20%, the equivalent to the blue bar on the left. But on the y-axis, you have an additional information, which is the median residual maturity in terms of years, which is about 4 years. So you expect, on average, a complete rollover of the debt in 4 years. Of course, this is an average, so there are tails. Now, this long phasing in interest rate can be calculated. So I show here the result of projection of interest rates for non-financial corporations in the euro area on the left and for France on the right-hand side. So let's start with the blue lines. The blue lines show the rates of the new loans, which go up starting in 22, of course, and there's a peak. The peak is in the fall of 23, and then a decline. These are for new loans. So here we are talking about bank loans, so the new loans to these NFCs. And then the dotted line is a projection based on an econometric estimation of the bank lending rates depending on market rates. And we use forward markets to project these bank lending rates. And you see the decline after now. In the future, you see the decline that is smooth but continues up to, so here we stop in 25. But of course, this will continue later. And then the red line is the rate on outstanding amounts of loans. So it's an effective rate on the stock of debt. So the effective rate on that the firms have to pay on their debts, gross debt. And so you see an increase, which is much smoother, and then a plateau. And what is interesting is, in terms of projection, that it's about stable, which is the combination of two effects, which we could call extensive margin, which is that new debt is rolled over at a new interest rate, which is lower than the peak of the fall 23, but higher than previous interest rates. So this is the extensive margin, which pushes the curve up. And then you have an intensive margin, which is month after month, the new interest rate is lower than the previous one. So they cancel each other, and you have a stability of this effective rate. On the right-hand side, you have the same for France, and you see a little bit of the same picture, with the decline of the blue line. And the red line is a little bit increasing, but it's not steep. Okay, so despite the fact that France is among the countries with a higher maturity of the debt, so more delayed effect of this indirect channel of monetary policy transmission, it's not so, on aggregate, it's not so obvious, so not frightening in the year to come. Not a wall. Okay. Now, another thing that distinguishes the different countries is the share of bond financing. And here, France is really different from the other ones. 35% of the debt of NFCs on aggregate is market debt, whereas the share is about 15% for other countries. So why does it matter? It matters because of the right-hand side graph, where you see the increase of the interest rate on debt securities, which is ahead of the interest rate on bank loans by about 6 months. So there is much more reaction of the interest rate on bonds relative to the interest rate on bank loans. Hence, those firms that have borrow on the market, they face a higher interest rate much in advance compared to smaller firms that have not that borrow from their banks. So what does it matter? Here you have the result of a research by Alda Coimbra and Cherbovic, colleagues at the Banque de France, which is, so this is based on macro data for French firms, and they estimate the impact of investment at the firm level after a upward surprise of the interest rate by 100 basis points. And you see that after 2 years, time is in years, after 2 years, is about minus 4% on investment, on aggregate. And then on the right-hand side, they try to distinguish whether market debt behaves differently. So those firms that have borrowed heavily on the market behave differently. And the answer is yes, but only the first year. So the takeaway from this slide is that in fact, though firms that have borrowed on the market rather than in banks, they face higher interest rate sooner than the other ones. But the reaction is muted because if you add up the two graphs together, so for a firm that has only market debt compared to a firm that has only bank debt, which is of course an extreme example, the reaction the first year is muted, and it's only afterwards. So it's not so important, in fact, concerning the direct channel of monetary policy. So taking stock, so I will not take stock, I will move to the last part, which is heterogeneity across firms. And here I want to show the difference, so the difference between SMEs and larger firms. In terms of the indirect versus direct channel of monetary policy transmission. So these are two graphs that have been built based on microdata, firm-level data. For interest rates on new loans, so it's the black plain line. So you see in both cases an increase starting in 22 and even more in 23. We still don't have the data for 24. In both cases, maybe steeper, well, it is steeper for SMEs compared to larger firms. Okay? But in terms of effective cost of debt, which is the dotted line, gray dotted line, it's about stable for SMEs, whereas it is rising about the same as the rate of new loans for intermediate size enterprises. We don't take larger firms because the sample is too small. So this is very important because it seems to be the case that SMEs, in fact, have fared relatively well in this surge of interest rates, which is a bit against the prior, well, at least my prior, when I started to study this topic. So you may, it's even more the case in terms of percent of value added. I like to look at the ratio of interest expenses over value added, because then you can compare to gross operating surplus, which is generally expressed in terms of value added. And you see that the ratio is about stable for SMEs, whereas it's increasing for intermediate sized enterprises. And, well, in gross terms, at least in gross terms, maybe not in net terms. And beware of the scale, because larger firms have more leverage. So it means much more for them than for SMEs. So you may say, well, but SMEs, they don't borrow because they're just rationed. So let's look at credit rationing. And here, the evidence is not so straightforward. So here you have, it's based on a survey to the firms where it is asked whether they have received a positive answer from their bank when they want to borrow, at least 75% of the amount they asked for. And so you will see that the percentage of firms that have been satisfied with their bank, their loan request at their bank is stable for investment. It's close to 100% for larger firms, also for SMEs, a bit less for micro enterprises, which is common in this kind of survey. But stable, it doesn't decline in recent time. The evidence is more mixed for cash loans. It's possible that micro enterprises have been rationed in recent time. The green line is downward sloping. Finally, we should not simplify too much the heterogeneity across firms. Even when you filter the data for sector and for size, you still get a lot of heterogeneity. And I like this graph, which is a kind of measure of heterogeneity within size bands and sectors for different indicators of financial health, growth of value added, EBITDA, cash, or leverage. And you see a huge increase in heterogeneity during the pandemic, a decline afterwards. But when the inflation started to increase and interest rates adjusted upwards, there was still a lot of heterogeneity within these bins, meaning that we are not capturing everything with just the size. And now I just conclude. First, I think we have some evidence that monetary policy works. So this is something that we should bring back home. Secondly, there is a lot of heterogeneity of the indirect channel across countries and firm sizes. Here I have focused on this indirect channel to MFCs. Of course, there is also the direct channel, there is the asset price channel, there are other channels I've not looked at, and you have the households also, which we could talk about. So it's only a part of the monetary policy transmission. And average resilience may hide fat tails, and this is my final word. We see an increase in bankruptcy rates, in somehow also in default rates, which is more limited, and how is it that we have some aggregate resilience so far of the corporate sector, and at the same time, an increase in bankruptcies? This is possible if you have fat tails, you have a lot of heterogeneity. The medium is fine, but then you have the tail. So I will stop here, and I'm happy to answer questions. Thank you.
Well, thank you very much, Deputy Governor. We like data here at the Peterson Institute, and you certainly gave us that in abundance. And I should say to all our viewers that the presentation will be available at the Peterson website after this event. But I mean, there was so much to delve into, and I guess I want to really just start with a couple of questions before we open up to the audience. And one of the charts you showed that I thought was really striking was the share of bond financing across the Eurozone, where I think you could say that France is well underway to that capital markets union. with a much higher share of bond financing than in the rest of the Eurozone. So I guess the first question is, why is that much higher in France? And apart from what you showed, maybe what you would expect, which is a faster monetary transmission and potentially a reduction in the cross-country variation in the Eurozone from the Capital Market Union project, are there any other effects on monetary transmission that you might envision? For instance, lower rates relative to today?
Thank you for this very important question. So yes, this graph is striking. I think it's well explained by the demography of firms. France is specific if you compare, for instance, with Germany or Italy, where you have a polarization of firm size with a quite a large number of very large firms with very high leverage, and that intensively taps the market. And at the other end, smaller firms that have no access to the market. So I think this and lack of medium-size Mittelstand, or Italy the equivalent, where you have firms that have leverage and rely heavily on the banking sector. So I think it can be well explained by the demography of firms in France, which is really different from other countries. Then in terms of capital market union, it's true that some firms have used to tap the market. They would love to have lower borrowing costs if there was more diversification of the investors across the euro area. You could maybe think about the capital market union as a democratization of access to market. So you want not just large firms to access the market, but also smaller firms. I think it's Annika Schiap and co-authors that called that spare tire for firms. So the ability to play with two sources of funding, bank and non-bank. And also you also have private equity and so, but here I'm limiting myself on market debt. And then you could think of intensive margin and extensive margin. So intensive margins is lower the investment cost for firms, capital cost for firms, but you also have the extensive margin, access to more sources of funding. And I think the capital market union project is of this. So from the side of the savers, they would have more opportunities to diversify, and then they would be offered products that have a better liquidity, better trade-off between return and safety. So this would, on the whole, reduce the cost for funding investment.
The other chart that really stuck with me was the chart you had showing the non-financial sector leverage, where again, as you highlighted, both on a gross and a net basis, France sort of stuck out as the only country in the Euro, or at least the large economy in the Eurozone, where leverage is not falling. So I guess two questions on that. Why is that? Is it once again the distribution of firms, or is there another issue? And then when you look at the Eurozone, you find that overall non-financial sector leverage is falling. And this at the same time as we hear notions that, well, there's all this extra investment demand, and that's why we should think about our star rising and things like that. When you see a chart like that, why should we think that our star is rising? I would say that what your chart shows is actually perhaps the opposite.
Okay, so if you don't mind, I will separate the two questions. The first one is, why is leverage increasing in France, whereas it's declining in the other large euro area countries? And I think maybe not the main explanation, but at least one sizable explanation is that investment has been more dynamic in France than in other countries. In terms of investment rate, it's much higher compared to Germany, for instance. The corporate investment in France is higher in percent of value added. But on the margin side, French firms have much lower margins compared to German firms. So then the result is that If they want to invest, they need to tell the market or to ask their banks for some loans. Then the second question is about R-star. So we are all in the dark concerning the R-star. I would say that in terms of demography, we had negative news recently in the euro area. In terms of productivity, we have also negative news. We have very good results in terms of employment, but really negative results in terms of productivity. So these are two main determinants of R-star. Then I would frame your question in a forward-looking way. Would the transition, for instance, lead to an increase in R-star if there is more investment? But it all depends on savings also. And savings are, as I showed, are higher than pre-COVID and not in their way down. So a possible scenario, which is completely speculative, would be that there is more saving for a while, less consumption, but maybe more investment. So this would be the nice story about the transition, that it could rely on private savings and private investment. We still don't know. I'm a bit skeptic about a fast recovery of R-star in the euro area. But well, the good news is that we are out of the zero lower bound trap. And the graph I showed on the interest rate on new loans started at 0, but it's just a standardization. But it's not expected to come back to pre-COVID rates. So here we have a bit of a buffer in terms of reacting to negative shocks.
Okay. I think we have time for a couple of questions from the audience. I have other questions, but if you have any, there is a mic in the middle of the room, or there is a traveling mic as well for those thus inclined. Yeah. And if you could please identify yourself. Well, right.
Thank you. Thank you, Anya. It's very good. Sorry, I have to give my name. Jean Pizanet, I'm a senior fellow here at the Peterson Institute and at Bruegel. I'm wondering about the time dimension. What you provided us with is with a snapshot of the current situation in terms of the heterogeneity across countries. Is there any evidence of a convergence towards a certain funding model, a reduction in heterogeneity, or is heterogeneity fundamentally stable?
Okay, difficult question. I would say on the side of households, we've seen really a convergence. It used to be the case that in some countries there was a lot of flexible rate, variable rate borrowing. There is still some, but mostly outside the euro area, for instance, Sweden. And fixed rate borrowing has been more widespread. So there is some convergence for households. For firms, so I don't see it so far. And we are starting from so much apart that even if there is some convergence, it will take time before we get a full convergence. Perhaps one message from the different dimensions of heterogeneity I've shown is that they're largely cancel out. So in some cases, for instance, you have more market borrowing, but at the same time, you see that investment reacts less to the interest rate on market interest rate. You see that, yes, SMEs are more exposed to credit rationing, but at the same time, they have more buffers. So it seems that you have some elements that go in different directions. It's also the case at the country level. I would not, based on this analysis, I cannot say in this country, and you also have the wage setting, you also have the other dimensions. So I cannot say today that monetary policy transmission would be faster in one country versus another one. I'm incapable, maybe someone knows that, but I'm incapable of concluding on this.
The last question.
Thank you. I'm Joe Gagnon, Senior Fellow here at Peterson. I have a question for you. In 2 weeks, as you know, we'll have an election here, and there's about a 50% chance that the candidate who wins will want to impose large tariffs in a trade war, especially aimed at China, but even at Europe and other countries, at least a 10%, if not a 20% tariff. And my understanding is that Europe probably will immediately retaliate with comparable tariffs. Our analysis here says this is both inflationary but also bad for growth. Do you agree from the point of view of Europe with that? And how do you see the implications for monetary policy and the value of the euro?
Okay, so this question is especially
There's no dodging Trump this
here
week.
because I know you have here at the Peterson Institute worked hard on this question and published extensively. So I'm not going to reinvent the wheel. So from a European perspective, if there is no, so the first effect without retaliation would be lower growth, and but the inflation would be more for the US than for Europe, which would just have less activity. And if there is no retaliation, there is no reason to have inflation. But if you trust the Lerner equivalence, then the dollar would appreciate, and the dollar appreciates, and then the euro would depreciate, and this would feed inflation in the euro area. So the distribution of inflation across the Atlantic depends not only of the retaliation, even without retaliation, it depends on how the exchange rate would react. And then, of course, with retaliation, well, this is really for Europe, which has built itself as an open economy. It's extremely worrying, both due to the possible tariffs vis-à-vis European goods, but also as a victim of the trade war between the US and China. So it's a double hit. And frankly, we are very worried about that.
Okay, with that real political assessment, let me bring this edition of the Peterson Institute Macro Week to a close. I will remind our audience that we will be back at 1 p.m. Eastern Time with the Governor of the Reserve Bank of New Zealand, Adrian Orr, who will talk about monetary policy in an age of volatility. But please join me in thanking Deputy Governor Quéré for an extremely enlightening and informative session, and we hope to welcome you back to the Peterson Institute in the near future again.
Thank you, Jacob. Thank you.